Hey everybody, it's been a long time since we've done one of these no-huddle market updates. We do these in between our podcasts, our monthly market brief articles, our quarterly screencast, which would be market outlook, the quarterly scouting report, and halftime update. Whenever things get scary enough, and I think that things are generally there's always a reason to be scared, I think. But when we start to get enough people who are coming into our office for review meetings, new clients coming on board through our financial planning process, when we have people asking us a lot of questions on places like Twitter or just emailing us through our website or just contacting us with a lot of questions because people are scared, there comes a point where it's a little bit, I'll call it a scarier time than normal. And whenever that happens and things kind of seem like they're going haywire, we like to do one of these no-huddle market updates, which are, again, kind of a supplement to everything else we do, just to let you know what's going on, put things in perspective, and then give you some objective information so you can kind of see what's really going on and kind of sift through all the noise. So as always, I start with a quote, of course, Larry Williams. He said, "Be quick to turn bullish when the market's going up. So be quick to turn bullish, but take your time turning bearish because the market is up more than 70% of the time." Now, obviously, in our trend following models, tactical models, we want to try to avoid as much of the downside as humanly possible during catastrophic bear markets, market crashes during that 30% of the time when the market's not going up. But obviously, there's no such thing as missing all of it. So where we are right now, however, is maybe going to surprise you. So let's look at Trump 1.0 versus Trump 2.0. Let's start with this chart who I got from my friend Lance McDonald. This is what you're looking at here is 2018, an analog graph of 2018 here and going forward. And then you can see the other line, the shorter line here, is the current situation. And so we can kind of see what things look like back in 2018 and how they look now and just kind of compare the two. So it's playing out not perfectly, of course, because that's not even what it should do, but it's playing out similarly. And then here we have another chart, which is basically looking at 2019, and then it's overlaying here the brown line. It's overlaying the current situation, and you can see some notes here, like at the bottom of the market here. In 2019, Trump calls off all the tariffs on Mexico. Then Trump and Xi talk on a trade deal here, and so on and so forth. So you can kind of see how obviously you can curve fit these things. So you got to be careful. It's one of the reasons I don't really like analog charts. Is you can kind of, if you look for the data enough, you can find something perfect that looks great. So this doesn't mean that the market's going to do exactly what we're seeing here in the white from 2019, but it is interesting that there's two separate charts that kind of look similar, and we obviously have the same president doing similar things this time around. So the question is, how bad are things right now? And that's where I want to show you a chart of the S&P 500 since this bull market began. And by the way, the reason they call them bull markets and bear markets is because bulls attack with their horns from the bottom up and bears attack with their claws from the top down. So that's why bull markets are good markets and bear markets are bad markets. But in this bull market that we've seen here for the past, we'll call it 2 years, 2.5 years almost, we've seen drawdowns or corrections or pullbacks of 9%. So that's a pretty severe pullback. We've got a mild correction here of about 10.8%. We'll just call it 11%. Then we had a drop here, pullback of 6% in early 2024 in spring. Then we had a pretty fast 10% drop almost in the market last summer, which freaked a lot of people out. Of course, nobody remembers any of these drops at this point because, it's scary at the time, but it's over pretty quickly. And then now we've got this drop here in the S&P intraday on a base of about 6.8% or so from top to bottom. And we'll just call it 7%. But what I'm seeing here, very objectively, is pullbacks and corrections within a long-term bull market. So that's healthy. It's the market's breathing. I don't look at this as what we've seen just recently, even though it's been a bad few weeks. This last 3 weeks has been really tough, especially for growth stocks, high relative strength stocks, technology, AI, microprocessors, things like that. So a lot of technology has been hit even harder than what you're seeing here. But that's what tends to happen with high RS stocks. But I digress. But again, I just want to reiterate what I'm seeing here is I'm seeing pullbacks and corrections in all-encompassing long-term bull market, which is good. Now, what we don't want to see, this is 2021 and 2022. These are bigger drops, as you can see. So the market was going up. We're having pullbacks and corrections during an uptrend, and all of a sudden it wasn't an uptrend anymore. The market goes down about 12% falls below water here. This is the 200-day moving average or the 200-day trend line of the market, S&P 500. Tries to get its mouth above water and get some air, drops back below water, tries to get some air again a second time, and just doesn't make it and falls another 17, almost 18%. Excuse me. And then once it finally pulls back, it falls again. I could have made this even bigger if we wanted to. I could have taken it from the top here in spring all the way down to the summer lows, but I didn't. But anyway, it bounces, doesn't even get to water. Doesn't even get to the surface of water here, being the 200-day moving average, before it falls 20% from that point. And then finally, we start to see some higher highs and higher lows, which is by definition an uptrend. And then we kind of start to see the market get back above its 200-day moving average and stay there. So we're not seeing this right now, not even close. So if this market gets below water, tries to get back above it again, and gets dunked underwater again in today's market, and I'll go back to that chart. If that starts to happen here, then we could be in the middle of a trend change. But something else to keep in mind is that markets don't go straight down. I mean, yes, there's a saying in the market that it goes up the escalator and down the elevator, but it doesn't go straight down. So there's going to be choppiness. There's also every investment we own in our portfolio has its own trend. It's not like the market is what we own, and when things go down, everything goes down. Obviously, the goal is to rotate out of weakness into stronger positions. So if this market is changing, if this is some sort of top, at the bare minimum, what we're going to see is some rotation from certain sectors to other sectors. So we might see some rotation between asset classes, whether it be U.S. to international stocks, maybe commodities. So there's a lot that could change here. But right now, again, we are still looking at a short-term pullback, call it a severe pullback, and corrections before that in an overall uptrend. My inverse traffic light chart that I do every month. I did another one and updated this just because I thought it was interesting. So not only are we still in the green zone, so that's the first good thing, but we've kind of tapped that line between the caution zone and the green zone, which is represented by the summer highs last year. But if I take this chart really quick and I go right back, you can see that point is also sitting at the 200-day moving average or the 40-week moving average, which are the same things mathematically. So the fact that we have a 200-day moving average here and some potential strong levels of support below our feet at this caution line is a point of convergence that means something. And the market should be able to hold that. And if it doesn't and it breaks into this caution zone, it shouldn't stay there very long if the market is still strong. Now, if it stays below into this caution zone, tries to get back above into the green zone and can't, it's like hits it like a ceiling and falls back down, that's a sign that maybe the market isn't doing so well. And again, we're going to have to start seeing some pretty major changes in portfolio makeup. From a big picture standpoint, flying up to 30,000 feet, when you look at all the major asset classes and you rank them from top to bottom, number one, again, putting things in perspective here, is by far U.S. stocks with international stocks close behind it. So U.S. stocks are number one, international stocks are number two. Number three, ironically, are T-bills, or in other words, money market, just cash in the bank. Number four, recently, because small caps have struggled so much this past few weeks, is small cap U.S. stocks. And then we have commodities, which are barely beating treasuries. Now, within the commodity space, yes, there's some investments like gold, silver, that are doing well. But as a basket, as an entire, aggregate, commodities are not doing that well. Now, a couple other, a little bit nerdier, so bear with me here. This is the VIX, or the volatility index, seasonally. So when you look at the VIX seasonally, you tend to see a spike here in the VIX here in mid-March, which is kind of what we've seen. And then you kind of see this dip in the stock market. Well, we're at this point right now in mid-March, we're closing in on it, I should say, where the VIX tends to spike and on average and then pull back. And we start to see less volatility and higher markets. So I think it's interesting to see that that's kind of what we've seen in February and March, is this last 3 weeks, this drop. This is not today's market, by the way. This is just seasonality. This is averages going back years. So the fact that this is the drop we've seen is very similar to the historical averages, and that we've also seen a volatility spike at the same time is very, very interesting to me, and I'll be curious to see if it's going to happen again. This is a chart from my friend Ryan Dietrich. The second week of March lows are common. So when you look at the last 20 years, this is the average movement of the S&P over the last 20 years. what you tend to see is the market doing relatively well through the first, call it month and a half to 2 months. Then you get this pullback, which is what we've seen this year, ironically. And then the market kind of bottoms and tends to head higher from there, up 9.72% for the year on average. That's 20 years. So again, this is more evidence, just historical evidence, averages that tell us, well, maybe we've seen this before. Maybe this isn't so abnormal after all, regardless of what we might be seeing in the news. And then lastly here, this is the NASDAQ 100. This is Jason Getfert over at Sentiment Trader. The NASDAQ 100, so the top 100 stocks on the NASDAQ, closed below its 200-day moving average, so its 200-day trend line, for the first time in well over a year. And so what he's showing us here, and I know this looks a little bit nerdy, but what he's saying here is that every single time that the NASDAQ closed below its 200-day moving average after an extended run, and it went down 3.5% over the next 2 weeks, then it led to a bear market or a market crash. However, with the 2-week drawdown after the crack below the 200-day moving average, if it was less than 3.5%, the 1-year returns were positive a year later every single time. So what we need to be looking at, if we care about the statistic, understanding that nothing's guaranteed in life, right, is that because the NASDAQ broke below the 200-day moving average for the first time in a long time, if the NASDAQ falls another 3.5% or lower, it might be one more notch on the belt in the call it voting for the bears, or in other words, evidence suggesting a bear market or market crash coming. So this is one of the many things I'll be looking at, again, as I take a way to the evidence approach to investing. I don't believe in just saying, if this happens, then do that. You got to look at the weight of the evidence. You got to look at a bunch of different indicators, metrics. It's a lot more complicated than just saying, if this happens, then that. So with that being said, finish with another quote here. John Templeton, portfolio manager, Sir John Templeton, I should say. He said, bull markets are born on pessimism. They grow on skepticism, mature on optimism, and they die on euphoria. And I don't think that we're even close to euphoria yet. In fact, I don't have a chart for it to show you here, but we're seeing sentiment indicators and surveys at the most bearish points that they've been in years, since COVID. And if the market is that bearish right now, we're not even close to euphoria. We're not even there. So with that all being said, if you have any questions for me at all, if you want to get a hold of me, you have questions about your portfolio, you want a second opinion on your retirement plan, financial plan, estate plan, if you want a second opinion on your investment portfolio, you never have to be a client to ask a question, so feel free to get a hold of us here. And if you'd like to set up an intro call, just head to our website at libertaswealth.com, click the little button that says see if we're a good fit, answer some questions, and then we'll shoot an email to you to set up an intro call to get to know you a little bit better, tell you how we work with our clients, and go from there. But that's all I've got today, and we'll see you next time.